Hi there, welcome to Kneppy Invest. In today's video, I'm going to be focusing on a company called Bigtincan. This is a company I've been following quite closely over the past 3 or 4 years, ever since they listed on the ASX, simply because back 3 or 4 years ago, this would be the sort of company I would be interested in investing. There's a SaaS company with high gross profit margins and focused more on revenue growth, particularly annual recurring revenue over profitability and operating cash flow and free cash flow positiveness. However, times have changed, and these are the sort of companies I have no interest in investing right now, simply because they are out of favor with the market. But more importantly, the reason they are out of favor with the market is rising interest rates. If we start to see interest rates starting to fall again, which is a possibility, particularly if we do move into a recession and inflation starts to fall quite considerably, these companies could become more favorable. Unfortunately, the valuations and the share prices of these companies have fallen a significant amount, which means they need to focus on becoming profitable because they're going to find it harder to raise capital in the future. Not only harder, but it's going to be more expensive for shareholders. And a company like Bigtincan, which has been acquisition hungry over the past 3 or 4 years, will find it harder to make acquisitions because it will be more expensive, and they really have to focus on organic growth. So it is good to see that it seems like Bigtincan's management has changed their tune recently, and they are focusing on increasing their scale, becoming profitable, becoming operating cash flow positive and free cash flow positive, which is the most important thing. So the question I do have for Bigtincan and any other companies like this is, where's the profit? Because this is going to be the question. The market is going to be asking these companies over the next few years if we do see elevated interest rates remain. If we start to see interest rates fall again, that will be a different story. So again, profitability of these sort of companies, or becoming profitable of these sort of companies, is the big question we need to ask the management of these companies. So what does Bigtincan do? They are a SaaS company, a software as a service. And this company is all about sales enablement. So improving the relationship between the seller and the buyer. Now, I have no experience in sales or anything like that. In fact, I'd probably be an awful salesperson because I don't really fully engage with the buyer, and I don't really care to fully engage with the buyer. I don't really care about that sort of thing. But it seems to me the most important thing about improving the relationship between the seller and buyer is that engagement point. And to improve the engagement, you do have to see the seller go through some learning and some content. So Bigtincan's intelligent enabled platform does all that in the attempt to improve that relationship between the seller and buyer. Bigtincan, founded 2011, so it's been around for over 10 years. And instead of being listed on the ASX for 3 or 4 years, it's actually been listed on the ASX for over 5 years, 24th of March 2017. Just shows you as you get older, the years just blend together. And what might seem like 3 or 4 years ago is in actual fact over 5 years ago. Current CEO is David Keane. He has a 4.1% holding in the company, which is fair enough. I might prefer a little bit higher holding for the CEO, but 4.1% is nothing to sneeze at. It's actually better than some companies. Some CEOs have 0% holding in the company they actually are running, which I think is not a good sign. Anyway, and then one of the major shareholders of Bigtincan is SQ Investors. They have a 13.7% stake. Now to the valuation of the company, looking at the markup, I have two numbers here, looking at two different dates. So if we go back to February of this year, so not February the 22nd, last time I did a video on Bigtincan, share price was 88 cents. That gave a market cap of the company of around about 480 million. Current share price of Bigtincan at the end of trading on June the 16th was 45 cents. So the share price has almost halved in 4 months, which means the market cap of Bigtincan is sitting right on $250 million right now, and it's continuing to fall. And the question is, how much further can this company fall, particularly because it does look like they are trying to turn their business around in terms of becoming profitable, becoming operational cash flow positive on a continuing basis, and more importantly, free cash flow positive. And the TCAN for Bigtincan is BTH. Now, where is the profit? That is the title of this video. And for the majority of its life as an ASX listed company, the management of Bigtincan didn't really care about profitability, didn't really care about becoming free cash flow positive or anything like that. They were just concerned about increasing revenue. And this company has increased their revenue consistently over the past 6 years. So this is the half-yearly financial data looking at revenue, income, which is profit, and cash flow from operations, going all the way back to 2016. And we can see revenue, which is the blue bar, increasing consistently through time. In fact, it's increased from 3.6 million to 45.9 million. So some of the increases in revenue is because of acquisitions, particularly the significant increase in revenue we did see from the previous half year to the most recent half year. They did make a significant acquisition. And I think, in my opinion, that was a really strategic good acquisition, but the market hasn't seen it like that because share price has taken a nosedive. But when you look at profit, which is the black bar, and the cash flow from operations, which is the green bar, those two have not been increasing like we have seen in revenue. So what this company has been doing with the increasing revenue or their cash receipts, they're putting most of that into trying to grow the company in the future, not really caring about profit or even caring about operating cash flow. And in fact, the profit and operating cash flow have been actually going worse or getting worse the last 2 years. We've seen profit all the way down to negative 10.5 million in the previous half year, and cash flow from operations as bad as negative 8.7 million 3 halves ago. So that's the question for Bigtincan. They need to see or translate, or what's the word? Convert revenue or the increasing revenue into profit and operating cash flow and free cash flow. But this is a particular slide from one of their presentations, how they are mentioning that they are now focused on operating leverage. They've mentioned here continued focus on operating leverage, but this is a new thing for the company. They haven't really been focusing on this all that long. So operating leverage just means as you see revenue growing or cash receipts growing through time, spending or the cost is not growing as quickly as that. So the increasing revenue should lead to profitability and should lead to the company becoming continually operating cash flow positive and free cash flow positive eventually. So the management of this company is aware of what they need to achieve. And that is the first step we need to see management make, particularly of these companies that are unprofitable and out of favor with the market right now. Now let's have a look at the most recent March quarter results for Bigtincan. But before I actually have a look at that, we're just going to go back 1 year ago. And if we look at the March quarter for financial year 21, so back then this company didn't really care about operating leverage. All they cared about was increasing revenue. And to increase revenue, they didn't care if spending increased at a higher rate than revenue. So in this particular quarter, before they made a significant acquisition, receipts to customers was 12.2 million. And they were operating cash flow negative by $3.4 million. If we go to the 6 or the 9 months to date, receipts to customers was 27.3 million. And they spent more money on staff than they received in receipts. So they spent almost $30 million on staff costs for the first 9 months of financial year 21, but only received 27.3 million. This shows you this company was focused more on spending big to achieve growth or revenue growth in the future. So there is a balance, and a really good balance between revenue growth and becoming operating cash flow positive, free cash flow positive profitability. At this point in time, they weren't caring about that balance. It was all just a land grab. Get as many customers as you can, no matter how. And to achieve that, they spent big. The other thing to take into account when you're talking about Bigtincan, they were operating cash flow negative, 3.4 million. They also spent a lot of money on IP, which is research and development. And for this particular quarter, they spent $1.3 million on intellectual property. They also spent $1.7 million on an acquisition, and they raised $35 million. So if you combine everything together, cash on hand actually increased in this particular quarter by almost $25 million because of that capital raising. But if we move into the future with the valuation of this company lower or significantly lower at this point in time, it's going to be harder to do capital raisings without significantly diluting current shareholders. So that's the problem Bigtincan, other companies have right now with a decreasing valuation, is that capital raisings will be harder to achieve, and they need to find ways to profitability. So that's the big point here when it comes to Bigtincan. Now let's have a look at the most recent Appendix 4C for Bigtincan. And the most important thing about this particular Appendix 4C, they were operating cash flow positive by 451,000. It is on the small side, but it's a step in the right direction. I like to see the company maintain being operating cash flow positive or even increase it quite considerably over the next few quarters. Receipts and customers increased 22 million from last year, and the main reason, or one of the main reasons for that, was because of an acquisition, but there is some organic growth in there as well. And receipts from customers is now growing at a greater rate than staff costs, because in this particular quarter, receipts from customers was 34.3 million, staff costs only 26.7 million. So we are starting to see a bit of a gap between receipts and staff costs. So again, that's a step in the right direction. But just like last year, this company is spending a lot of money on intellectual property. In fact, it's increased significantly up to $4.4 million in this one quarter. Now, intellectual property is a continual expenditure. It's research and development. And if you sort of translate that or convert that to a full year, that's almost $20 million just on just on intellectual property. So receipts up 22 million, advertising marketing up 700,000, staff costs up 15 million, and administration costs up 2.2 million. But combined, cash receipts actually grew at a quicker rate than spending, and that's why the company has become operating cash flow positive in this quarter. But for the first 9 months of the year, they were still operating cash flow negative by $3.1 million, even though they generated $75 million in cash receipts. But again, this company has absolutely loved spending money to achieve greater cash receipts, to achieve greater revenue. And more than likely, that will be coming to an end. They're going to be more focused on becoming profitable and generating cash flow in their business. And the reason why companies like these need to be able to generate cash flow in the business is that's the best way to grow a company, is to grow a company using the cash you generate in the business. Because if you are able to do that, you don't have to do capital raisings. You don't have to borrow money from the bank. The vast majority of these SaaS-like companies are almost solely focused, well, not solely focused, but they are highly focused on annualized recurring revenue, ARR. And you'll see a lot of these type of graphs in any presentation a SaaS company will release, focused solely on how annual recurring revenue has been increasing over the past few years. And Bigtincan is no different. And they are expecting annual recurring revenue to be about $119 million by the end of this financial year. So that's not far away from now. Now, in the past, an annual recurring revenue of 119 million should probably suggest the valuation of this company would be above at least 500 million, even approaching $1 billion. But again, times have changed. The market cap of this company is now around 250 million, which is only about 2 times annual recurring revenue. So on that basis, on that one metric, this company is possibly moving towards pretty good value. With the measurement of Bigtincan trying to show the world, or investing world, that they do have some operating leverage, I thought it'd be a good idea to look at how receipts have grown over the past 5 years compared to how spending has grown over the past 5 years. There's not much difference between the growth in either, which shows me that this company hasn't shown the market, the investing world, that there is any operating leverage at this point in time. There's a little bit of operating leverage, but not a lot, because if we go back to the March quarter 2017 to the most recent quarter, receipts have grown at 12.4% per quarter, while costs have grown at 11.7% per quarter. So there is a little bit of a better, higher increase in receipts than costs, but not by a lot. And to be fair with you, receipt or costs are growing at a very similar rate to receipts. I would like to see receipts growing at a significantly higher rate than costs. And at this point in time, Bigtincan has not shown me and not shown the market that they do have operating leverage or enough operating leverage to become highly profitable, to become highly free cash flow positive. And that's what the market and I want to see out of Bigtincan. Now on to some charts for Bigtincan. The first one here is the daily chart. And in the next slide, we'll look at the weekly chart. And in this particular chart, we're going all the way back to July 2021. In August of 2021, that's when the company made a significant acquisition. Initially, the market loved that news from the company, that acquisition, because the share price increased from $1.20 to a high of $1.50. But ever since that high of $1.50 last August, the share price has been dropping. The share price has moved into a well-defined downtrend. Lots of negative sentiment in this company, and that's true for a lot of other tech companies as well. There was only one short relief rally or dead cat bounce. That was in March of this year. Share price actually increased from about 60 cents all the way to a high of about 94 cents. That looked like maybe there was a shift in sentiment, but that rally was on low volume. When you ever see a rally like that, you want to see high volume. And the reason why there was low volume was there was no conviction in the market at that point in time. And that would have been a good time to sell out of Bigtincan if you're a shareholder, because the share price has fallen significantly since then. And right now it's down to about 45 cents. Potentially today, on the 17th of June, the share price will fall towards 40 cents because another big day is in store for the ASX. That horizontal dash line will become evident what that dash line is in the next slide. It's not quite the COVID-19 lows. In fact, the COVID-19 lows we did see, the panic lows, we did see where it was about 25 cents to Bigtincan. But when the share price of Bigtincan fell below 40 cents, we saw a lot of buying in March of 2020. So hopefully, if the share price can fall below 40 cents again over the next few weeks, potentially, that's when we might see some buying coming in for Bigtincan, just because of what we saw in March of 2020. Whether that happens remains to be seen, just because of the negative sentiment, not only in this company, but also in the economy at large. As we look at the weekly chart for Bigtincan, going all the way back to 2018, the share price of this company was, just looking at the weekly chart, actually in an uptrend from 2018 all the way through to August 2021. There was a little bit of a dip during the COVID-19 financial panic. That was a short-term dip. In fact, the share price went all the way down to 25 cents. And when the share price actually fell below 40 cents, we saw a lot of buying coming in. The reason why there was a lot of buying, or we know there was a lot of buying, is when you look at the weekly candlesticks, we see a very long lower tail, which tells me when the share price fell towards about 25, 30 cents, we saw a lot of participants in the market decide Bigtincan was good value, and that's why we saw the share price starting to rise. And then there was that V-shaped recovery. Share price shot up all the way from that low of 25 cents to a high of about $1.56 in September, October of 2020. Then we did see share price fall away and then rise again during 2021, and the share price went back up to that previous high of $1.56. So there was a double top here, and a double top is a sort of a bearish sign. And ever since that high, as I showed you in the previous slide, share price has been falling, consistently falling week on week. And the share price is moving towards that level, that range between 25 and 40 cents, where we did see a lot of buying in March 2020. The other thing here is take a look at volume. So during 2020, particularly when the share price was rising from 25 cents to $1.56, there was a lot of volume, a lot of interest in the market around this company. The next time we saw the share price rise towards $1.56 in 2021, volume was considerably lower. And during the last few months, as the share price has been dropping, we are seeing lower volume. So what I want to see is higher volumes coming through. If we see higher volumes, particularly what we saw during 2020 coming in, that would show me that the market is becoming interested in Bigtincan. They might be thinking there is some value around this company. If we don't see any volume, that is showing us that the market is still not interested in the value of this company, not interested in Bigtincan. So the company has to be wary of this, because as the share price decreases, as the value of this company decreases also, it will become harder, and I've mentioned this a few times, it will become harder and more painful for shareholders if they do capital raisings, and it's going to be harder for the company to do acquisitions. So they have to really focus on organic growth, really focus on becoming profitable, really focus on becoming free cash flow positive. Because again, I've mentioned this already, the best way to grow a company is becoming free cash flow positive and using the cash you generate in the business to grow the company in the future. Relying on capital raisings, relying on debt to grow a company is not the best way to grow a company for the shareholders and for the long term. That's all I have for this video on Bigtincan's March quarter results for financial year 22. If you do have any thoughts about this company, I'd love to hear them, particularly if you totally disagree with me and you think there's really good value in this company right now. I'd love to hear from you. So leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.